Imagine, if you will, a time long, long ago when a very young Carolyn was sitting at a desk, hunched over, with her only light the flame of a candle. She's toiled for hours and hours in a cramped, cold room, wishing that Mr. Scrooge would let her have one more lump of coal. But alas, no. Would her workday never end? Well, that's the era that we're going to be talking about today as we talk about closing entries. This is something that we really don't do anymore except for in accounting class. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Mr. Scrooge. Terrence. So in this video, we are going to complete the accounting cycle, old school style. If you're one of my accounting students, you'll definitely want to hang on for this one. If you're a business owner or you're a bookkeeper, you could wander off and do something else and not watch this video. Go walk your dog, play with your kids, or if you just want to hang out with me because I'm the coolest accountant in the world, please feel free. So when we are talking about closing entries, the first thing we have to understand is the difference between a permanent account and a temporary account. And the best way that I can explain this is to think about a scoreboard. You're watching the Red Sox beat the Yankees, for example. Well, we go through 9 innings, we get to the end of the inning, and we say the Red Sox won, the Yankees lost terribly by a whole bunch of runs. It was a bloodbath. It was awful. Sorry. Well, when we go into the next baseball game, we don't carry that score forward. It goes back to 0 and we start all over again for the new game. Well, it's the same thing for our income statement accounts. We have collected all of that information all month long, and now we're like, great, we had this much in revenue, we had this much in expenses, and we've got a profit. Well, in the olden days, what we needed to do for the new month is we needed to zero out those accounts so that starting the new month, the new baseball game, we would be at 0 and we could begin to count the new innings, the new runs. So closing entries are a holdover from that. With accounting software, this is done automatically in the background. But back in the olden days when Scrooge and I were hanging out, sharing a piece of gristle, we had to do things in a manual way. Of course, Mr. Scrooge didn't do it. I had to do all the work. So we're going to go through those closing entries to show how we close out our temporary accounts, our revenues, our expenses, and our drawing accounts. And what's going to be left over when we've done that is our permanent account balances, which would be things like cash and accounts receivable, accounts payable, and our capital account. So here we go. I'm going to jump into the spreadsheet. Whoo! Whew. Wow. So when we're talking about closing entries, the place that we're starting is with our adjusted trial balance. And I've pulled that from the spreadsheet that we've been using for our other journal transactions and adjusting journal transactions. So here we are with our adjusted trial balance that we came up with before we did our financial statements here. And what we're looking at to close in our closing entries would be these accounts right here. So these are our temporary accounts. We're going to close out Joe Smith drawing. We're going to close out our 2 revenue accounts. We're going to close out our expense accounts. And when we're done with this old-fashioned exercise, we are going to end up with only these accounts still with a balance in them, our assets, our liabilities, and our capital account, our equity. So how do we do that? Well, there are 2 methods of doing closing entries. One is probably really old school, and the other one is a little less old school, but still pretty ancient. So closing entries method number 1 uses a new account called an income summary account. An income summary serves as a clearing account. We're going to move things in and out of it, and when we're done with it, the balance will be 0. Method number 2 skips that and just goes directly to the different accounts that we're impacting. So in method number 1, first thing we're going to do is we're going to close out our revenue account. So if we come over to our adjusted trial balance, we have 2 revenue accounts that we need to close out. So revenue accounts have a normal credit balance. So in order to close those out, we need to debit that amount. So here in our first closing entry, we're going to debit fees earned for $61,100, and we're going to debit rent revenue for $3,000. And the offsetting account is this new pass-through account called income summary. So our credit is to income summary. In the second closing entry, we need to close out all of our expense accounts so that they go back to zero and we're ready to start the new month fresh. So all of these expense accounts have a normal debit balance. So in order to close them out, we need to credit them. So here are all of our amounts from our adjusted trial balance for our expenses, and we are going to offset that by debiting this income summary account. Now let's pause there for just a moment and jump back to our financial statements. So here in our income statement, look at this. We've got $64,100 for total revenue. And here in our closing entries, we've got $64,100 going to income summary. And come back here, we've got $27,930 for expenses. And look, that's what we have here too. So we know we're on the right track. So right now, those balances, if we were to go post this right now, those balances would come to zero for our income accounts and for our expense accounts. But we're not done yet, because remember that we said our net income then becomes part of our capital. It's part of our owner's equity. So this ends up getting transferred up into our equity accounts. So let's see how that magically happens. So right here is our profit, right? So it's the difference between our income and our expenses. There's our profit. And we are crediting our Joe Smith capital account to increase his equity. And then the other side of that is our mysterious income summary account. So that's journal entry number 3. Now the final closing entry that we need to do is we need to close this drawing account into our capital account. So we are reducing Joe Smith's capital, and we are clearing that drawing account so that coming into the new month, we're starting at zero with that as well. We can't just make it go away. We need to capture the fact that Joe Smith's capital has decreased by that amount because he took some money out. So our final journal entry, closing entry, is to credit Joe Smith's drawing to empty that account and debit Joe Smith capital to reduce his capital amount. At this point, we go to our general ledger and we post those transactions just like we did with our regular journal entries and with our adjusting journal entries. And similarly to our adjusting entries, with the item right here, we're going to put closing so that we know this is a closing entry. We're doing it on the 20, and we would be entering that debit there, which would give us a balance now of zero. So once we've posted all of those accounts, what we're going to end up with is a post-closing trial balance, and that is going to include only our assets, our liabilities, and our equity, our capital account. So that's method number 1. With closing entries method number 2, it gets rid of that income summary piece. And here's what we do. We're still debiting our income accounts. We're still crediting all of our expense accounts. But instead of using this income summary Joe Smith capital entry, we are going right to the capital account. So we're cutting out that middleman account. So that brings this entry into balance because we have our revenue minus our expenses, and then the difference between the two is our net income. And then we still need to do the entry where we close out our drawing account into Joe Smith's capital account. That account is the same. So just like with closing entries method number 1, we would go into our general ledger, we would post all of those amounts, get the new balances, and then those new balances will come into our post-closing trial balance. These are the beginning balances for the new month. So we're always going to have our assets, our liabilities, and our capital accounts coming into the new month, and our expense and income accounts being returned to zero. Now, why am I giving you 2 methods for doing closing entries? As I mentioned, this is really only something that you're going to see in accounting class. right? And different textbooks will use these two different methods. So I could be teaching from one textbook, it's using method 1, teaching from a second textbook using method 2. So what happens in real life in the modern age? Mr. Scrooge has long gone to his reward, and I'm a much older accountant now. Well, accounting software does this automatically in the background. So you're never going to do closing entries other than in accounting class. So there you have it. That brings us to the end of the entire accounting cycle. So now we get to go home. We get to put our feet up. We get to see how Tiny Tim is doing. And then tomorrow we start all over again. So until next time, stay balanced, my friends.